Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes.
All right, good afternoon, everyone. My name is Lakshay, and welcome to my Tuesday session on real estate and taxes. And today, we're going to be talking about, is 30-year mortgage actually a good idea or not? So a little bit of backstory. What has happened is in some countries like Japan and the US, they already had a higher, mortgage period. It could be 35 years, 40 years, and even 100 years in, some cases where they're passing on the mortgage to multiple generations. But with Canada's major lenders, that wasn't the case. After the bubble burst in 2008, what they did was they changed the amortization maximum from 35 years to 30 years, and then now we're sitting at 25 years. But as of August 1st, 2024, this has changed. They've increased the amortization for first-time home buyers buying for prices less than $1 million to 30 years. From 25 to 30 years is the new increase in the mortgage, and this is a great news for first-time home buyers sitting on the fence thinking about, should I make that decision of buying a home or not? The government is doing everything in their power to bring them back to the market and have them reinvest in the economy. So what are some of the down payment rules? In down payment rule, you basically have home which is less than 500,000, you must pay 5%. For anywhere between 500 to 999, you must pay 10%. And for anything above $1 million, you must be paying a 20% minimum. This, after you pay 20% minimum, the government allows you to not pay the CMHC default insurance. So what this basically means is, if you are meeting all of these criteria, you might still be able to, afford a home without having to pay the additional premium of default insurance. This is offered by CMHC, and it basically means that because you're paying such a low down payment, you have a high chance of defaulting on your payments. This way, they come in and they insure the mortgage overall, and in the case where you end up defaulting, the bank have insurance to recoup the money from them. Now let's look at an example. So on a $500,000 home with a down payment of 5%, which is $25,000, the mortgage insurance works out. Mortgage insurance will be roughly 4%, which is $19,000. So your total mortgage would be $494,000. So 500 minus the down payment of $25,000 plus the $19,000 worth of total mortgage insurance will work out to $494,000. What will be the difference on this versus on a 25-year mortgage versus a 30-year mortgage? On a 25-year mortgage, your monthly cost will be working out to $2,873. And on a 30-year mortgage, your monthly interest or monthly cost will be working out to $2,636. This basically means you are saving roughly on average $250 on a monthly basis from the extended amortization period. This might be a great news for someone who cannot really afford the home right now, and it just really makes it a little bit more affordable in that sense. And but if you look at it on the flip side, the interest has gone up significantly. Why? Because now you have 5 more years added to your payment plan. Basically, what a $500,000 home would cost $861,000 in 25 years, but in 30 years, it's now going to cost you $949,000, which is $80,000 more than what was previously discussed. So what are some of the advantages of this program? Well, now you have the ability to stretch the mortgage payments to a longer period of time, making your home buying decision a little bit more comfortable, a little bit more smoother, and a little bit more affordable. So not only this, it also gives you access to a higher price point. You might only be looking at homes which is at $500,000 mark, but now you can move your budget up to $600 or $650 depending on, if your monthly mortgage payments come within your budget. This is the best way basically to qualify for more pricier home. So hopefully this is gonna, bring the buyers in the market. And it basically also allows you to qualify for more debt. So if you were to buy multiple homes in, future, this is a great way to get into the market and, start testing the market to see if this becomes affordable. You can eventually become an investor later on with more and more homes and qualify for more debt. And, this could definitely work in your favor. What are some of the disadvantages? Well, disadvantages would mean you have to pay less now, but you have to pay more interest later. In the previous example, we noticed on a $500,000 home, it was $861 under the 25-year mortgage, but $949 under the 30-year mortgage, which is $80,000 more. So I'm going to leave that decision up to you. There is a disadvantage because you are paying $80,000 more interest in the additional 5 years. So that is sort of a disadvantage. Now, because of the savings and things that you might be on track for, maybe you want to retire by 60, but with the additional, debt you have taken on with the additional 5 years, you might not be able to retire by the age of 60. You might have to stay up until 64, working and paying off those debt. Again, a bit of a disadvantage. The third one is with lower down payment and affordable mortgage options, more and more buyers will come into the market. With more demand, the prices of homes for first-time home buyers can eventually go up because of the supply-demand ratio will basically change with this. So overall, in conclusion, what I would say is look at the opportunity cost. Can you take that $250 that you're saving and invest somewhere else which will compound and grow at a higher rate? Maybe. Or if you don't believe in that, still you can look into the 30-year option and pay off the mortgage in still 25 years. How? Just at the end of the year, pay a little bit towards your home loan, which reduces the principal. So even after taking the 30-year mortgage, you can use you can prepay between 15 to 20% in order to keep the decision and your home buying process a little bit less expensive. So again, that option is still available. Discuss with your accountant, your realtor, what your personal situation allows you to do before committing to yourself to a 30-year or versus a 25-year mortgage. That's what I would lead this presentation with. One of the bonus tips that I have and a new announcement that we just got was first-time home buyers are eligible to withdraw $35,000 maximum from their RSP towards their first home, right? With the new announcement, now you will be allowed to withdraw $60,000 towards your first home. So again, the government is seeing that inflation, the price of home is going up. So how can we make a little bit more momentum in the market? They're giving you the right tools to invite your buyer, or if you're a realtor, or if you are first-time home buyer, to get into the market and look at that decision of buying your first home. And with that, I'm going to leave today's presentation. If you haven't subscribed to my YouTube channel on real estate and taxes, please do so now. I share every week a brand new topic at 2 p.m. and we also do a live session on Zoom. So don't forget to join that as well. Thanks and have a good day.